Hello all, welcome to Get Into IAS, and in this video we are going to deal with the lesson money stock measures. Fine. So the first term to be noted down is money stock. What is money stock? The total amount of money available in an economy is called as what? Money supply. So money supply is what? The total amount of money available in an economy. See, today the economy may generate 100 rupees. So this is the money supply for that period of time. Tomorrow 200 rupees. So this is the money supply. This money keeps rotating here and there. That is called as what? Money supply. So this is called as the stock of money. This 100 is the stock of money. 200 is the stock of money. That is called as money stock. What is called as money? So money is the coins and currency. Fine. You know we have coins minted by Government of India. We have currencies printed by RBI. So not only these two things constitute the money, but also the financial assets also constitute what? Money. For example, see, I may have rupees worth 100. Okay, I may have a revenue of 100 rupees and I may have a house worth 200 rupees. Okay, so my total money supply, so the total money stock within me is what? This 100 plus this asset 200. Fine. So this is what? The coins, currencies not only constitute the money but also the financial assets in the economy constitute what? Money. Because with the help of this house I generate what? I generate money. Fine. This is called as money. So money can be classified based on the liquidity. Liquidity is the currency. Fine. How can you easily exchange the money? That is called as what? Liquidity. For example, the money in your hand has greater liquidity than the money at the bank. For example, see, I am having 5 rupees in my hand. I can spend this 5 rupees very easily. But in case if this 5 rupees is deposited in the bank, I should go swipe my ATM, take the 5 rupees and then spend. So the time period is big. That's why the money at hand has greater liquidity when compared to the money at the bank. Next, coming to the sectorization of economy. So we have two type of sectors in our economy. First one is the domestic sector and the next is calculated as rest of the world. Our domestic sector, rest of the world. That is the sectors in our economy. So inside the domestic sector, it is subclassified into households, non-financial commercial sectors, government securities and financial corporations. All this comes under what? The domestic sector. Fine. So I'll repeat. See, the households inside our economy will generate certain amount of employment and that is how it will come under the economy. Next, the non-financial commercial sectors. Next, the general government will come under the domestic sector. Next, the financial corporations, that is all the companies and all will come under this. So it's called as the domestic sector and the remaining is termed as the rest of the world. Now coming to the financial corporations. We saw here, right, the financial corporations, these are very important, fine, because they are used for the credit creation. So under the financial corporation, we have the banking sector, that is the RBI and the banks constitute the financial corporations. Moving to domestic sector is subdivided into two, that is the money issuing sector and the money holding sector. Issuing is giving, holding is taking back, fine. So we'll see what is money issuing sector. Money issuing means money giving. So the RBI and the banking sector constitute the money issuing sector. And the money holding sector, who all hold the money, save the money, that is the household and other financial corporations, that is deposits. Next, non-financial commercial sectors. Okay. So all these come under what? The money holding sector. Now moving to the monetary and liquidity aggregates. Very important aggregates. Monetary and liquidity aggregates. So what is monetary aggregate? See, the measure of money supply in the national economy is called as monetary aggregates. So take India as a whole, the measure of money. See, GDP is also the monetary value. So that is also a kind of what? Monetary aggregate. Fine. So the measure of money supply in the national economy is called as monetary aggregate. What is called as liquidity aggregate? So under this, the ease of financial transaction is taken into account. Liquidity means, I already told you all, the currency in your hand is more liquid than the currency at your bank, right? So that's why under the liquidity aggregate, how can you easily transact the money for your business purposes? Okay, that is called as liquidity aggregate. Now coming to the monetary aggregates, it is divided into four. One is the reserve money or the base money or M0. Next one is the narrow money M1. Next one is the intermediate money M2, M3, bad money. Fine. Let's deal with reserve money. Under the monetary aggregate, we are going to deal with the first one, that is the reserve aggregate. So reserve money is denoted as M0. See, the money held with the public. So we have certain amount of money in our hands, right? So that one, plus banks. Banks also hold certain amount of money, that is the currency in circulation, because we have deposits in bank, that is also being circulated from bank 1 to bank 2, person 1 to person 2, that is also currency in circulation. Plus RBI holds certain kind of deposit, that is the cash reserve ratio. All this come under what? M0. For example, M0 can be classified as currency in circulation. See, now in our economy, we are giving money and getting a product. That is called as currency in circulation. And plus bankers deposit with RBI. See, bankers, right? Bank 1 will deposit certain cash reserve ratio with RBI. Bank 2 also will deposit. So, all these amount will come here. Bankers deposit with RBI. Plus other deposits with RBI. We'll deal with this. I'll let you know. Other deposits of RBI will also come under what? M0. So, this is called as M0. See, I'll elaborate M0 again. See, the currency in circulation is the total amount of rupee notes issued by RBI and the rupee coins issued by the government of India. So, I told you all currency in circulation means what and all amount we have in hand, that is the currency plus the coins, right? Then the currency in circulation is equal to the total of the currency held by both public and banks. See, I have certain amount of currency in my hand. Over here I told I have, that is very liquid. And certain amount of currency I deposited at bank. I can withdraw that at any time. So these are also currency at circulation. So the currency at hand and the currency at the bank are being circulated for various purposes. So those are the currency under circulation. Fine. Next, bankers deposit with RBI includes cash reserve ratio. We already dealt with cash reserve ratio. And excess reserves also comes under the deposits of RBI. We'll deal with that. See, the banks keep CRR with RBI stipulated by RBI. So, RBI will tell so much amount of percentage you should keep it with me. Fine. So, some banks keep more amount of cash, extra cash with RBI, that is called as excess reserve. See, normally the banks should keep certain amount with RBI as CRR, but certain banks keep extra amount more than the stipulated CRR, that is called as excess reserve. Fine. You have to know this term excess reserve. Fine. Now, what are the other deposits with RBI? Over here we saw, right, other deposits with RBI. Who all will deposit with RBI? See, deposits of quasi-government and other financial institutions including primary dealers. See, we have various state governments, quasi-governments. So, all these type of governments deposit their amount with the RBI. Next, balances in the accounts of foreign central banks and governments. See, governments deposit and foreign central banks deposit certain amount of money with RBI. So, all this is calculated under the deposits under the RBI. Next one, accounts of international agencies such as IMF. So, you have to pay certain amount of money borrowed from IMF or World Bank or ADB, right? So, you have to pay that back to them, and hence there is a deposit under RBI for that. Next one, provident, gratuity and guarantee funds of RBI staffs. So, for all the staffs of RBI, the PF, provident, the gratuity and the guarantee funds are stored inside the RBI deposits. Fine. Next one, narrow money. Coming to M1. So, under narrow money, so we've done with reserve money. Now, moving to narrow money. Narrow money is denoted as M1. See, narrow money, it is the currency with public. Same way, like what we saw over there, it is the currency with the public plus demand deposits with the bank plus other deposits with RBI. See, I told you all currency with the public means we have certain amount of currency plus coins in our hand that is held for the circulation. Demand deposit with the bank means, see, I am going and depositing my money with the bank. There are two deposits, time deposits and demand deposits, right? Under time deposit, we have the fixed deposit, that is there is certain time, after that time, after the maturity only you can take the amount from the bank, right? So, you can't take time deposits from the bank at any time. Demand deposit is whenever I demand, the bank should give my money back to me, right? For example, the money you take from the ATM. So, that is your wish to take your money from the bank. That is called as demand deposit, right? So, this demand deposit with the bank will come under M1 and other deposits with the RBI. We'll deal with that. See, over here, the financial assets included in the category of M1 are fewer than those included in the category of M2. So, M1 will be lesser than what? M1 will be lesser than M2. Okay, we'll deal with M2 next. That is the intermediate money. Now, we are dealing with M1, that is narrow money. So, narrow money is very narrow, that is smaller than M2. That's what they're telling here. See, and then this means it defines money in a narrower sense. So, I already told you all the formula for M1. Now, currency with the public, I am dealing with the formula here. What is currency with the public? What is currency with the public? Currency with the public is equal to the currency in circulation minus cash on hand with the banking system. See, earlier we saw currency in circulation means what and all we had in our hand plus the deposits in the bank, right? Over here they're telling currency with the public is equal to the currency in circulation minus cash on hand with the banking system. Over here, what and all money you're having in the hand, only that is calculated, and the money that is deposited in the bank is minused. Okay, that is currency in circulation, that is only in your hands, right? Next one, demand deposits are those deposits that can be withdrawn by a depositor at any point of time. I told you what is a demand deposit, right? Next, under this demand deposit itself, we have two kinds of deposits. One is the current deposits and the next one is the saving deposit. So we'll deal with that. See, under the saving deposits, you have two components, namely the demand liability and the time liability. See, this savings component is there, right? Under the demand deposit, there are two kinds of account I told you, current and saving. Under saving, it is divided into two, that is the demand liability and the time liability. So demand liability means the banks has to give that amount. They are liable to give that amount when the customer demands. But time liability, it is not like that, I told you. So under this, most part of the saving deposits is demand liabilities only. So over here, they are telling most part is demand. So see, normally if you take in your banking system also, if you are saving in any of the bank, your time liabilities, your time deposits won't be more. Your demand deposits only will be more. Same way, the banks has to give demand liabilities only more, right? Right. So over here see, but few saving deposits can be withdrawn only on some performance or having some happenings. You know that. For example, a saving deposit made in the name of a child. See, there is a saving deposit over here made in the name of a child, okay, may be deposited with the condition that it can be withdrawn only after the child become a major. So if the child becomes a major, 18 years only, you can withdraw the money from the bank account. That is called as what? Time liability. Correct. So demand means whenever you want, you can take that. And this is an example of time liability portion of saving deposit. So time liability means only when the child turns 18, you can take that money from the bank. Until then, you can't take that money from the bank. Fine. So in M1, only the demand liability portion is included. So the above equation can be rewritten. See, I told you all, time liability is not taken into account for the M1 calculation. See, normally in demand deposits, we have current and savings account. Under savings, you have demand liability and time liability. But this time liability is not taken into account in the M1 formula. So this is deducted. So now you can rewrite the formula as currency with the public. I told you currency only in your hand plus currency deposits with the banking system. So they divided that into two. Currency what and all I deposited, that is with the banking system, plus demand liability. So over here only demand liabilities is taken, time liability is not taken. Demand liabilities portion of the saving deposit. So in the savings you have only demand, this time liability is not taken into account, plus other deposits of the RBI. You know what are the other deposits of RBI, I told you. Next one, moving to the M2. Intermediate money is termed to be M2. So this is the formula for, so I'll let you know the formula for M2, but note this down. See, I already told you all, M1 is shorter than M2, right? And M2 is more shorter than M3. We'll deal with M3 later. Now keep in mind M3, M2 and then M1, okay? Fine. Now moving into the formula of intermediate money. So before that, what is an intermediate money? So it is called intermediate money for the reason financial assets included in this category are more than those included in the M1 but less than those included in M3. Why it is called as intermediate money means it is between M1 and M3. It is in the middle, intermediate position. That's why it is called as what? M2 or intermediate money. Okay. See, the formula for this is M2 will be equal to M1. All of this will come. All of M1 will come. So I already dealt with M1. So this whole formula rewritten here will come here plus time liability. See over here, they are adding time liabilities in what? In the savings account. Over here, this time liabilities is not taken into account, but in the intermediate money, this time liabilities also is taken into account. Time liabilities of saving deposits plus what is the formula? Certificates of deposits. I already told you what is certificates of deposits. Fine. Certificates of deposits issued by bank, term deposits with the banking system. You know what is term deposits? Plus term deposits excluding FCNR up to and including 1 year maturity with the banking system. What is FCNR? That is the foreign currency non-resident bank. FCNR is the foreign amount over here. See, the formula is M2 will be equal to M1 plus time liabilities of the savings deposits plus the certificate of deposits plus the term deposits. We have something called as the term deposit. So demand deposit, we can demand it anytime. Term deposit, there will be a certain maturity period. Only during the completion of this maturity period, the bank will give you that amount. So that is a term deposit, but excluding the foreign currency, up to 1 year maturity. So this foreign currency is excluded and the remaining term deposits are taken into account into what? The intermediate money. I hope you got the point, right? So narrow money is M1, intermediate money is between M3 and M1. Now let's move to the M3, right? So now moving to the broad money is denoted as M3. So M3 is greater than M2 and it is greater than M1 also. How is this formula arrived? See, the financial assets of M3 is more. That is, there are more amount of financial assets present inside M3 and then M2 is lesser than M3, M1 is lesser than M2. Okay, M1 is very narrow, fine. So now moving to the formula of M3. So the formula of M3 is M2. M2 we already dealt with M2 plus term deposits excluding foreign currency non-resident banks deposits of over 1 year maturity. See over here, term deposits. I told about the two deposits, demand deposits and the term deposits. Demand deposits, whenever you are demanding to the bank, it should give to you. But term deposit is not like that. Why? Because term deposit has a fixed maturity date. On that date only I can go to the banks and ask for my money. Fine. So with this term deposit, the banks can lend to a lot of people, right? So the deposit what I have kept in the bank, with that the banks will lend to a lot of people, right? For that's why the term deposit is being used. Okay, so the term deposits excluding foreign currency non-resident bank deposit. So there are non-resident banks, foreign banks in India, so that has certain foreign currency. So that is excluded from this term deposits. So they also have a kind of term deposit, right, in foreign currency, and so that is minused from the term deposits, right? And then that too over the 1 year maturity. Over the 1 year maturity, that only will be excluded. And plus the call borrowings from the non-depository financial corporations by the banking system. See, the banking system, for example, the banks need to lend a lot of money, right? For that, they need money to lend, right? So, they will get the money from the financial corporations. There are various other financial institutions, right? So, from them, they will get the money, and these financial corporations are non-depository. For example, take NBFCs. So, there are deposit taking NBFCs and there are certain NBFCs that do not take deposits also. So, how do they get money then? See, these NBFCs, right, they issue bonds, fine, they issue bonds. If they issue bonds, we go invest in that bond, right? So, that is called as share. So, with that shared amount, they lend to the bank. So, the amount pooled from the bond is lent to the banking system. So, the amount pooled from the bond is lent to where? The banking system, the banks, okay? So, from this amount, the bank lends to various other people or the institutions. So, this is how this third amount of money is calculated. That is the call borrowings from the non-depository financial corporations by the banking system. Over here, the term call borrowing means, see, if there is a lender and if there is a borrower, if the lender gives the money to the borrower within certain specified rate, that is, if there is no maturity date for the borrower to repay back the money, the lender may demand the money whenever he may want the money, right? So, maybe like the lender will give ₹100 to the borrower and ask day after tomorrow itself, fine. So, ask day after tomorrow or the day after that, fine. So, that is called as what? Call borrowings, fine. So, the call borrowings from the non-depository financial corporations by the banking system. So, over here the financial corporations will call borrow the money anytime from the banking system. So, that is called as what? That is called as M3. So, we will revise it again. M2 plus term deposits excluding the foreign currency of the non-resident banks deposits over 1 year maturity, and call borrowings from the non-depository financial corporations by the banking system. Now, we have done with money aggregates. Now, moving to liquidity aggregates. Now, under liquidity aggregates, we have L1, L2 and then L3. So, L1 is M3, broad money. M3 is broad money plus all deposits of post office saving banks. So we go deposit certain amount of money in post office, right? So those are post office savings banks, excluding national savings certificate. So national savings certificate is issued by Government of India. So excluding that, because this is a very long term. So excluding that, the remaining amount of the all deposits of post office savings banks is taken into account for L1, liquidity 1. What is liquidity 2? Liquidity 2 is this L2 is L1 plus term deposits with term lending institutions and refinancing institutions. So what is term deposits? I told you term deposits is, see, there are demand deposit and term deposit. Term deposit is there is certain a maturity date. So on that maturity date only you can go demand the money, and not the demand deposit will be like you can demand it anytime. So this is the term deposit with the term lending institutions. There are various other institutions like banks, right? So that term deposits is taken into account, and the refinancing institutions also has certain term deposits. What are refinancing institutions? I already told you all. See, the RBI will give money to NABARD. NABARD will give to various cooperative banks. Okay. So this is called as what? NABARD is directly not giving money. It is getting from RBI and then giving. So it acts as an intermediary. So this is called as refinancing. The getting of money from RBI and giving it to whom? The cooperative banks are called as refinancing. So all these term deposits of the refinancing institution, for example over here NABARD, is taken into account, plus term borrowings by the financial institutions. There are certain term borrowings. Same way like term deposits, there are term borrowings only by the financial institutions, plus certificate of deposits issued by the financial institutions. Certificates of deposit is nothing but, see, same thing. I go invest my money in a bank. The bank will tell me for a certain period of time, keep this certificate of deposit with you. I will pay you regular interest. So that is called a certificate of deposit. So all this will come under what? L2. What is L3? This L2, this whole L2 plus public deposits of NBFCs. So there are deposit taking NBFCs, right? So that deposit taking NBFC have what? Our money with them. So that is what? L3. Fine. Okay, now coming to the last topic of this chapter, money multiplier. So money multiplier is denoted as MP. So money multiplier formula is the broad money M3 divided by the reserve money M0. Okay, this is the formula for money multiplier. So how can you learn money multiplier in easy manner? See, I am going and depositing 100 rupees inside a bank. Okay, depositing 100 rupees. What the bank will do, it will set aside 90 rupees and give 10 rupees as loan to another person. Again, what that person will do, this person will pay the 10 rupees principal plus the interest for this 10 rupees will be 5 rupees. He will pay 15 rupees back to the banks. Again, what the bank will do, it will take 5 rupees as a provisioning norm and give 10 rupees as a loan. See how this 100 rupees is being multiplied more and more from 90, 15 and 10. 100 rupees eventually will turn into 200 rupees at some point of time. So this concept is called as money multiplier. Money will keep multiplying. The more you lend, the money will multiply more. So this is called as what? Money multiplier. So we've done with a lesson called as money stock measures, and that's it for the lesson. Thank you for watching, and please subscribe to Get Into IAS and follow our Telegram link in the description box given below. Thank you.